Making another video here. This will be Macrotrends Research Part 2. And this is, point of me making this video is that there's been quite a bit of market turbulation lately, and usually whenever you have a lot of movement in the market, there are a lot of deals that could be found. People are panic selling out of some things. People tend to oversell, or industry insiders, hedge fund managers, money managers, they all tend to oversell some stocks, overbuy others. And especially right now, you'll be able to find a lot of things that are undervalued and oversold. So what I am doing here, I'm going to macrotrends.net, clicking on the stock screener like we did in Macrotrends Research Part 1. And I'm narrowing down the 6,341 companies down to 1,179 by limiting the PE ratio to 0.1, so we're not showing negative price to earnings ratio, maximum of 20, so that we're not showing too many overvalued companies. We're selecting an operating margin of 0 and a net margin of 0, so that we're not looking at companies that are net losing money at the end of the quarter. Forward PE of 1, so we're not seeing any negative price to earnings ratio for the projected next 12 months. Maximum of 25, so we're including some companies that are they're projected to become less profitable into the future, as opposed to this 20. But a lot of times the analysts' estimates are not as accurate as what we see. Then the PS ratio, no minimum, because the lower the PS, the better. Maximum of 3, so we're not seeing too many overvalued companies. The rest of this I'm not touching. And what we have are, I'm going to go ahead and sort by industry here. What we have are the rest of the companies that fall within the criteria that we've set. And we see quite a few familiar names. We see GoPro, Sonos, Sony, and GoPro PE of 8 at a market cap of just about 1 billion. Sonos 13, Sony 13. And there are quite a few recognizable names here. We'll continue to go through them. We see Ford, General Motors, Honda, Toyota, Polaris, Harley Davidson. We see Barclays, a lot of banks, Deutsche Bank. We see Citigroup, Bank United, JP Morgan, Wells Fargo. A lot of banks. We see Fox, Netflix, the PE of 15. So Netflix is actually market cap cut to 74 billion from I think it was like 500 billion just a couple of months ago. So that one probably got oversold. That's a good example. Let's see. SiriusXM. We see Owens Corning, United Rentals, DR Horton, Toll Brothers, Home Depot, Lowe's. And so kind of why we're seeing some of these names. Let me pull up. Let me go back to, here we go. No, next one. So the auto manufacturers, they have very low profit margins, and they tend to trade at very low PE ratios. That's just pretty typical. So I wouldn't necessarily jump into those. You gotta open up these tabs and evaluate their financials with the methods that we've gone over in the past, and see if it's a good investment. Another thing you'll run into is a lot of Chinese stocks on here. Let's see if I can find one. I seen one when we were scrolling through. But the reason why some of these Chinese stocks are popping up on here is because, as we covered in the other video, a lot of them were marked by the SEC, Holding Foreign Companies Accountable Act, in which 80 different Chinese companies were listed and are going to be required to provide additional accounting, open up their books to the SEC. The PCAOB is going to go into China, or they want to go into China, evaluate the earnings and the accounting for a lot of these companies, and see if there are any gap accounting principles being violated. And the threat is that these companies or board members or employees can be sanctioned and eventually, potentially, delisted from the New York Stock Exchange. So you're going to see, you'll see names on here like, what's a big one? Renesola. You'll see Neo. That's a big one. You will see Canadian Solar is one of my favorites. Jinko Solar, another one of my favorites. 360 Digitech, JD.com, Xpeng. These are some big names here. So you'll see Chinese stocks that are undervalued. What else? You'll see bank stocks that are undervalued, because the argument now is, yes, interest rates increasing would increase margins for banks, but right now, especially right now, there are fears of recessions. So there's pressure to buy. There would be pressure to buy the bank stocks because of the interest rates going up, but because the looming fear of recession, there'd be less people taking out loans in the future, more people defaulting on previous loans. So banks would be something that'll be oversold. And then finance, right? That'll fall on that. Gaming, it's seen as a non-necessity industry. So as financial tightening occurs, less people will be spending money on leisure type things. Alibaba, we just passed that one. That's a Chinese company. That's going to get lumped into that HFCAA drama. So definitely know what's going on and assess the risk in regard to these different indexes, or different industries, I should say. Oil and gas, they are, you can see the 1 year change over here for a lot of these oil and gas companies, which pretty much everything in the stock market that's not oil and gas is going down year over year. But these oil and gas companies you see up from 10 to up, this one here 100% up, and the PE ratio still being very low. They are trying to make up for prior year losses by increasing their profit margins, and with the supply crunch on the industry, with multiple countries outlawing Russian oil and OPEC not meeting production guidelines, there's an oil shortage. So really, you can charge whatever price you want. People are going to pay it. So that's kind of a reason why the PE ratio is so low, even though they're seeing such huge year-over-year changes in the stock price. And how long that goes on for, kind of decide that. Real estate, with recession fears, people are going to be selling out of real estate pretty heavily. See it as more risky. What else? Retail, people aren't going to be shopping as much if there's a recession. People, and especially with inflation going up. So there's quite a bit of companies falling in this desirable range here that we set aside, and that just goes to show you how sold off everything is. So you can come through here, maybe find some of your favorite names, do more research into them, see what their long-term outlook is, what the strategy is, what you wouldn't mind holding, through the turbulence, and you can make quite a bit of if you have the stomach to hold this stuff. If it continues to fall, then you can end up making some good money on it. And that's usually where I would have the most success in the past. Is uh, right now I don't have the income or the savings to put more into the market than I currently have. But it's good to prepare. During the bull markets, it's good to prepare and start putting money aside for an eventual downturn like this, because in the past I have been a huge buyer in terms, whenever the market is down this dramatically. And as long as you hold through the absolute peak of the absolute trough of the bear market, and you have the stomach to hold into the beginning of the next bull market, you make pretty significant returns. A lot of these companies are seeing multi-year lows, some of them all-time lows. And so it's like if you would have started investing in them back in 2000, 20 years ago, you're kind of taking advantage of the situation. It's like you're trading back in time. So keep an eye out for that. Do some research. Do your due diligence. If it seems like some of these are too low to be true, too good to be true, maybe look at the macro industry and see, oh, it's a Chinese stock and these are trading lower due to political tension, or oh, it's a bank, these are trading low due to fear of a recession, which could have this unintended consequence, and just be aware of that. All right, thanks.